Bismillahirrahmanirrahim. Assalamu alaikum class. Today we are going to discuss the effect of capital structure on financial performance of companies or the overall performance of companies. First of all, the capital structure of an organization has a very huge impact on the performance of companies as it comprises of the assets, as it defines the amount available to the organization. First of all, we need to understand what is capital structure all about. The capital structure is the particular combination of debts and equity used by a company to finance its overall operations and growth. The accounting equation accounting equation says that asset is equals to liabilities plus owner's equity. That is the accounting equation that gives you that whatever are the assets owned by the organization, they are available to the organization with the help of amount provided by either the liabilities or either the owner's equity. So that particular asset is equal to liabilities plus owner's equity. The liabilities plus owner's equity, that defines your capital structure. That is the amount of overall finance available to the organization in order to manage their assets. And whatever is the combination of that particular liability and owner's equity, that defines the capital structure of the organization. The combination of that particular that particular accounting equation is very carefully selected. We always need to understand that it's not like the case that any kind of amount of asset liabilities or any kind of amount of owner's equity can be taken or can be selected in order to finance the overall operations of the organization. One has to carefully understand, one has to carefully evaluate the market in order to better understand which particular combination should be opted before financing any organization. So in simple, if we say that it is the particular combination of debts and equity. Debts is the amount that is the borrowed money that is somehow invested in the organization by the investors, whereas equity is the amount. Equity is also kind of borrowed money that is somehow invested by the owner of the organization. The capital structures can either use both of them or can either take any one option. They can either select 100% owner's equity or either select 100% debt structure. By issuing equity, firms give up some ownership in the company without the need to pay back investors. It means that you are not bound to pay back. It's not the case, obviously, whenever you invest in any particular organization. Even in sole proprietorship, one invests in hopes of profit. Nobody invests without expecting the return, without expecting the payback. So, however, you're not bound to pay back at a particular time or at a particular period. There is no restriction for the management of an organization to pay back at a particular time. By issuing equity, however, the ownership is somehow shared with other people. Firms give up some ownership in the company without the need to pay back. That is defined already. But we also have to keep in mind the fact that in corporations, in joint stock companies, the shareholders always expect the profits. You always have to select a very balanced combination of whenever the organization earns the retained earning. One has to keep in mind that whoever is investing in your company, they are expecting the return. So in case if you keep the whole net income into the reserves area, that might offense some of the shareholders. And in case if you continuously, if you keep on paying the whole net income in the form of dividends to the shareholder, that will restrict, and you're not keeping any kind of reserves for expansion, reserves for growth, reserves for contingencies. So you will somehow face no growth within the company. Your company growth will be restricted by this particular step. So whenever you're earning the net income, you are earning the income throughout the year. With the net income, you have to select a combination. A limited, a particular amount should be paid to certain shareholders, should be paid to all shareholders in order to keep them motivated. And a particular amount should be kept in reserves in order to promote expansion and growth of the company. In case if you're not paying, the companies that do not pay any dividend for a longer period of time, at times they start losing their shareholders. The shareholders start selling the firm's shares within the stock market, that can negatively influence your share value in the stock market. The second option with the capital structure is the debt. Companies increases their leverage by needing to pay back investors. The difference between the equity-based capital structure and the liability-based capital structure is that in equity-based capital structure, you share the ownership, whereas in liability-based capital structure, you do not share the ownership. Rather, the ownership remains in the hands of few shareholders, and the company is thus provided with the leverage effect. What is leverage effect? Leverage effect is actually associated with the debt. Whenever you start the business with the borrowed money, instead of dividends, obviously, whenever you share the ownership by gathering money in the form of share, with the help of shares, you have to distribute the profit as per the defined percentage, as per the defined proportion, or as per the defined share of a particular shareholder. Whereas in case of debt, debt is always borrowed against some certain percentage, that is interest. Interest is the interest can be considered as the rent of the borrowed money. That is always a fixed amount, with the a fixed amount, or with on the fixed at a fixed percentage. So in that case, whether you're earning zero income, whether you're earning thousands, whether you're earning millions, you always have to pay back the same amount to the investors. Whereas that is not the case with the equity-based capital structure. In that case, you will have to share the dividend as per the share of that particular shareholder. So in that liability-based capital structure, after paying a very limited amount to the shareholder, to the investor, to the creditor, you are somehow left with huge amounts. But one has to keep in mind the fact that leverage effect plays in both directions. If you're earning millions, you will be left with a huge share after paying off a little amount. That is the defined proportion of the liability, the debt taken, the percentage on the basis of that percentage. But on the contrary, you always have to keep in mind the fact that the same scenario exists in case if you're earning zero profits. You also have to pay back the same amount to the investor that often leads to the failure to pay back that particular interest or return the principal to the creditor will lead to, that may result in bankruptcy of an organization. The bankruptcy of an organization, that is the most important threat or the risk associated with liability-based capital structure, that is somehow not in case of equity-based capital structure, although you are provided with shared profits and shared losses. But in a liability-based capital structure, the creditor has the right to file bankruptcy in case if you're unable to pay back their dues. So debt consists of borrowed money that is due back to the lender, commonly with interest expense, that is we have already discussed. Next comes, now here we can see that is that is the data taken from a particular website, and that shows the capital structure of two different examples of capital structure. Capital structure, this particular in high leverage organization, the dark blue, navy blue section shows the asset section. Asset is equals to liabilities plus owner's equity. Asset is reflected by the navy blue section. The pink section shows the liabilities or the borrowed money by the organization, and the light blue section reflects that shows the equity based amount of equity in a particular organization. And that also explains the fact that the assets are always purchased with the help of liabilities and owner's equity. Although this is not a particular, there is no hard and fast rule that only these kind of capital structures can be taken. It can either be in this particular example, in the first case where that shows the high leverage value of an organization. In that case, that shows 80% liability and 20% equity. That is the high leverage capital structure, or the liability. We also consider it the liability based capital structure. Whereas in the other example, that is the low leverage capital structure. In that case, that is 80% equity and 20% debt. At times, there is no hard and fast rule. The organization may opt for 50-50, 50% liability and 50% owner's equity, or they may go for 70% liability or 30% owner's equity, or vice versa, as per the risk evaluated on the basis of market analysis. One has to keep in mind the fact that capital structure of an organization, it is generally assumed that, okay, whatever the capital structure you want to opt, you can go ahead with it. But it's not the case. The capital structure of an organization always based on the nature of commodity, on the market scenario of that commodity in the market, the scope of that commodity in the market. In case if you have selected a particular commodity, if you're doing business of a commodity that is not well accepted in the market, or that do not have an increasing trend or promising sales in the market, and you go for the liability based capital structure, you are dealing with high risk and you might face failure. You might go for bankruptcy. So one has to keep in mind the fact that it's always the selection of this particular selection of any kind of capital structure should be carefully analyzed, should be carefully evaluated, and after careful evaluation, you should decide whether to go for the liability-based capital structure. One can go for 100% capital structure, 100% liability-based capital structure, or one can either opt 100% equity-based capital structure. but that should depend on the risk accumulated, risk calculated. There are so many formulas, there are so many financial formulas available for evaluating risk. However, the qualitative analysis has its own means. Qualitative analysis of any commodity will tell you what is the scope of that particular commodity in the market, and whether you should go for, whether you are taking more risk by going for the liability-based capital structure. For example, in a commodity, let's say in case if we are dealing with, if you're working with totally inelastic commodities, totally inelastic commodities. The commodities, inelastic commodities are those commodities that are uh, the basic needs. It can either be the basic needs of the basic needs, uh, or it can or life-saving needs of the market that are that are not much affected by the change in price, and they are not much affected by the change in price due to the reason that they are either the basic needs or either they are the raw materials. Uh, the elasticity of any commodity increases with the level of value addition uh, of any particular commodity. Let's say in case if we are dealing with inelastic commodity, in case if we are dealing with, sorry, in case if we are dealing with elastic commodity and we go for the liability based capital structure, elastic commodities can either be the confectionery items, it can either be the snacks, it can either be the junk foods. So in that case, if you're working with those, their sales is not predictable. You're not sure that what would be the sales uh, in the next few months or the whole year. One cannot predict the amount of sales. So in that case, if you're not confirmed about the sales, how can you uh, assure the payment of interest to the creditors? And that increases the risk. Whereas in case if you're dealing with the inelastic commodity, let's say I talk about the wheat in the market, the cereals in the market, not the value added ones, not the pasta, not some kind of value added snacks items, the basic wheat, the flour mills, the sugar mills. These are somehow, they somehow may be considered as the less elastic commodities. And in case if you deal with the life-saving drugs, that is totally inelastic in nature. So in that case, you can go for the liability-based capital structure, because once that is least affected by the price, change in price, you will be confirmed about the sales of that particular commodity. And when you're confirmed about the sales, you can project the sales of the whole year. In that case, you ensure, you're assured, and you can ensure the creditors about their interest payments or the payback of their principal amount. So whatever is the nature of your commodity, that ultimately defines your capital structure. If your capital structure is not compatible with the nature of commodity, or their scope is not well defined, you are risking you are going for a huge risk, and your organization might face the failure. Obviously, we have a lot of examples everywhere. There are a lot of examples of bankruptcies all over the world. In case if you're dealing with convenience goods, the basic necessities of life, they can somehow be, their business can be established with the help of liability-based capital structure. But in case you're working with high-tech items or the luxurious goods, their sales cannot be predicted. and you cannot consider them inelastic in nature. A little downfall in the economy, a little depression in the economy may result in a collapse of an organization when it is debt-based, when it is based on the debt finance. So we can conclude with the fact, we can somehow decide with the fact, we can go ahead with the fact that in case of increasing trend in any society, whenever there is an increasing trend of any particular commodity, the liability-based capital structure can be good. That provides you the leverage effect. Leverage effect, what is leverage effect? Leverage effects is somehow the multiplier effect of a growth. As we have discussed earlier, that whenever you go for the liability-based capital structure, after the payment of, in case of liability-based capital structure, the equity remains in the hands of few shareholders. The ownership remains in the hands of few shareholders. And after the payment of a particular amount of interest to the debtors, to the creditors, the rest of the profits, the whole bulk, is left with the few shareholders. So as a resultant, that results in the accumulation of wealth in few hands. Whereas in case of equity sharing, you always have to share the profits with all the shareholders, with all the owners that holds the ownership of the company. So leverage effect, whereas, so in case of increasing trend of any particular commodity in an economy, means when the economy is growing, when the economy is flourishing, at that time, the liability-based capital structure may be good, but the nature of commodity should also be evaluated. It is not necessary that the growing scenario, the growth is assumed on every commodity. You can say that in a particular economy, certain products can grow at a particular time, whereas some other commodities might be facing failures, might be facing decline because of either change in fashion, because of either change in technology, because of the availability of complements, because of the change in income scenario, or whatever. So whatever are the reasons, because of the change in weather, the natural environment, the growing needs, the change in socio-cultural environment, the political scenario, the legal scenario, there might be a lot of reasons for the change, for the reason behind the increase, the growth prospect of any commodity. So we can say that the commodities that have promising future, they can be considered inelastic or they can be considered inelastic in nature. They have consistent demand, evergreen demand. In that case, the liability-based capital structure may provide you the leverage benefit. But in case while dealing with the inelastic, while dealing with the elastic commodities, the same kind of liability structure will end you up with the slump in the business, will result in bankruptcy of your company. That is the slope. Certain things we need to understand when understanding the capital structure of an organization. The debt to equity ratio provides you the information how much debt a company is using to finance its asset relative to the value of shareholders' equity. That is also valuable information for the shareholders, for further investors, to whether to invest in a company or not. It also gives the information to prospective shareholders how much risk is associated with the company. The debt to equity ratio is useful in determining the riskiness of a company's borrowing practices. So if you're planning to invest in any joint stock company, in any public or private company, you always have to go for the capital structure. Just check it out. Just go ahead. Just see that how much risk is associated with the company, whether capital structure is more based on liability as compared to equity, and if there is decreasing trend, overall depression in the economy, that it's not suggested, it's not good to invest in that particular company. Whereas the equity-based companies are somehow, um, although they share less profit, although they are less promising in the sense that they do not provide you the leverage effect. However, they are somehow more safe to invest in the commodities. So the debt to equity ratio gives you the risk associated with the company. An optimal capital structure is the best mix of debt and equity financing that maximizes a company's market value while minimizing its cost of capital. And the cost of capital is with the liabilities. The cost of capital is the interest. That is the rent of the borrowed money that has to be paid to the creditor uh, at a particular at a fixed date, fixed period, fixed time. Whereas the cost of capital associated with equity-based capital structure with equity is the dividend. Dividend uh, should be paid to the shareholder as they have invested in the organization in hopes of profit. However, the management is not bound to pay back the dues to the shareholders. And here comes the leverage ratio, which we have discussed earlier. The leverage ratio is any one of several financial measurements that look at how much capital comes in the form of debt, or that assesses the ability of a company to meet financial obligations. The leverage ratio is very much important, while as we have discussed earlier, that in case if you're borrowing money, if you're selecting the liability-based capital structure, you always have to maintain the information whether you are capable to pay back the amount or not. In case if you're not capable to pay back the amount, if you have not estimated the future sales, in that case you won't be able to pay back the amount, and you might face bankruptcy. Your business might collapse before it starts. Now that is the end of our presentation. I hope you just get better understanding of the capital structure. This particular presentation was designed for the students, the investors, the organizational professionals, or those entrepreneurs who wants to invest in the organization, but they do not know. Especially in the third world countries, there are many people who want to invest, who want to establish the entities, but they do not know uh, what particular capital structure should be selected. So this presentation, this information will help you select the best capital structure for your organization. If you have carefully selected the capital structure of an organization, in that case, you will somehow minimize the risk. Although there are a lot of risks associated with the organization, but the most important risk that is associated with the organization is the amount of interest that has to be paid to the creditors. The most important risk any organization face is the fear of bankruptcy due to uh, the liabilities. So hope this particular presentation will help you all in selecting the best of capital structure for your organization. Not only for the theoretical, but I hope this presentation will not only help the students to perform well in the examination, but I believe the main core objective of this presentation should be uh, make the entrepreneurs, make the shareholders, make the investors, make the directors, or make the professionals capable of selecting the right capital structure, making this choice of making the right choice while selecting the capital structure for their organization. Hope you will do well in the future. Thank you so much. Allah Hafiz.